for tuning into this earnings conversation with arguably the stock of the day, purely based on performance. You can't really ask for more versus an 86% jump in revenue, or an even better 240% jump in EBITDA, or an even better over 300% jump in PAT. Yes, granted that it was a low base in the year ahead, but if you look at Indian Hotels' performance for the last 4 quarters, it has been exemplary. The question is to Puneet Chhatwal, and more on the lines of the recent conversation that we did with him, is that how much better can it get as the year rolls by ahead? Puneet, great having you. Thanks for joining in. Congratulations.
Thank you, Neeraj. Firstly, also thanks for using the backdrop that you have is a view from Taj Lands End, the Chambers. So
yes, it is.
So it goes with the day. I think our growth is been very strong, and our new openings of hotels, new openings of brands, new opening of new businesses is also adding to our asset management initiatives of upgrading our assets in even the difficult times of COVID. So I think the comprehensive brand management, the comprehensive brand stories around different brands in different segments, and very strong growth, having opened 16 hotels, having a pipeline of 73 hotels, planned to open 20 plus hotels in this financial. I think the best is yet to come. If I add to that the impact of G20, the World Cup cricket, the foreign tourist arrivals maybe going back to pre-COVID levels, and also in our portfolio, US and UK are still not at pre-COVID levels. So I think once they also get to pre-COVID level, we should see some more improvement in the top line on a like-for-like, and growth in the not like-for-like.
Okay. Puneet, it's been a great year. The question that comes to mind is, and especially now in your case, everybody expects you to do well. So the question is only how can you improve upon what the people anyways expect you to do, which is already a high benchmark, right? So the mind tries to think of what can lead growth ahead. Would it be ARR led? Because the question is not about whether ARRs can improve further, but whether ARRs can sustain at these levels. That's part one. And I know you'll give me the New York comparison, but I'm just trying to get the numbers here. Can ARRs lead the growth? Can higher occupancy lead the growth? Can newer properties and newer avenues, which is non-room length, actually lead growth for you in FY24 over FY23?
Let me try to address that differently. The occupancy and rate is a consequence of the balance in demand and supply.
Right.
So demand is strong, but the supply in the last 3 years, thanks to COVID, has been very constrained and is expected to be at a low level. There's, of course, new hotels coming. Even we are adding new hotels, and many more are getting signed. But to get to that balance of demand and supply, it may take another 2 to 3 years.
Sure.
So brands, and especially ours, with a very strong footprint on the Indian subcontinent, are expected to benefit from this increase in demand and constrained supply. So our ability to charge would be higher. And if your ability to charge is higher and you're a strong, well-established brand, the flow through to the bottom line should be and will remain healthy.
Okay, fair call. And yeah, so this goes on the lines of what you told me earlier as well about a couple of months ago, but good to know that you believe that that can actually improve. Now, when I look at your performance on the operational metrics as well, relative to pre-COVID too, there has been expansion. Now, tell us a bit about how much can this sustain or improve from where you are right now? Because I remember you telling me in the interview that we did at the Taj that it is not just the kind of improvement that you're seeing in room rates, but because 40-45% of your business is non-room rates linked, that is what will drive this. So tell us a bit about it. As you said at the cusp of FY24, how does it look like?
So you're right, Neeraj. Rate for the room is just one metric, but we tend to forget that in India, food and beverage business is very strong, is almost 1-to-1 when you put it against rooms. Weddings is a very strong segment in India. And with the growth in MICE, which is meetings, incentives, conference and events, especially on the backing of the new big convention centers opening in Delhi, in Pragati Maidan, or in Dwarka, or in Mumbai, I think all that are kind of boosters for demand, which we have not had in the past. So I think the more there is an improvement in the infrastructure, the more airports get built, the more high-speed trains come in, the more highways come in, and the more convention centers come in, the new demand and new sources of demand will follow, and the companies which are well established like ours will benefit from that.
Most certainly. So I read in the release and in your commentary that you maintaining, despite the speed pace at which you are signing newer properties and opening newer ones, you're maintaining that 50-50 balance. Now my question is that, are all the signings that you recently done on track, part one, for delivery largely around the dates that you would have envisaged? And would you maintain that balance going ahead at the end, let's say at the end of FY24 when we talk again? Would the balance would still be maintained?
Absolutely, because one of the key learnings for us, and especially in the last financial year, is we are benefiting from both the asset light model, which is 50%, and the asset heavy, the operating leases or the old portfolio, which is giving the positive operating leverage. So the absolute amount of increase and a greater significant increase is coming from the asset heavy portfolio, which is normal. That's how it works. In bad times, that is what takes you down. And that was the reason for balancing it, because we want to own our trophy assets. We cannot sell our crown jewels. So how to optimize performance in those assets by comprehensive asset management, and at the same time decrease the volatility in the portfolio and grow rapidly through the fee-based business. So I think a 50-50 is a very healthy model. If it's at the end of the day 40-60 or 45-55, it will be even healthier. So I think it's the speed of growth that will define whether we maintain 50-50 or it could even go down further, because the portfolio has expanded so much more.
Okay. I know I've run my course because we started the interview slightly late, Puneet, but I'll take the liberty of asking you one more question. People tell me that almost everything that was to know has now been spoken by Indian hotels in the last couple of quarters, in the last interaction with us as well. What a few fund managers who were invested told me to check is what is, so everybody believes that the revenue growth numbers are not a problem at all over the next 2-3 years. It is what companies individually do to the texture of growth, to the way they grow, which might make a difference. Now, I'm just trying to understand from you here that, do you believe the nuts and bolts or the pillars of growth over the course of the next 2 years or over FY24 would be different from what FY23 has been, or would the headline banner things will still be the same?
Well, some of the things are just a consequence of where you stand with your capital structure. So our capital structure has changed. We are a debt-free company, and we will remain debt-free, but we are sitting on a big positive cash flow when we opened the account this year, right? And if we keep adding to that free cash flows, it positions us very well for any consolidation opportunities that might come in. Till now, the growth has been mainly organic. So that's the first point. Second is, a part of this cash flow we can use to scale up new businesses we started in homestay, home delivery, quick service restaurants. We really did not put any capital behind those businesses. They were based on incremental cash flow. So I think we are now very well positioned to take on certain obligations in terms of, let's say, if we want to build ourselves 20, 30, 50 homestay properties or villas on the assets that we own, and we have the FSI available, that is possible, that is doable, because we have the means to do it without taking any debt. So I think there is a lot of interesting opportunities around the corner, and how to scale up our human brand, which definitely alone in QSR by the end of next year should be around 100 quick service restaurants. And that is significant, that in 3 to 4 years' time, without putting any capital behind it, because we took a decision that every Ginger Hotel's all-day dining will be called Cumin and will be done that way. So alone, that should give us 100 Cumin branded restaurants and presence on the airports, presence in shopping malls for a Cumin. So I think a lot of interesting things are around the corner besides our backbone. And our mainstream brand, our pride of the nation and pride of Indian hotels was, is, and will remain the Taj. So I think we have also made certain strides recently in signing our 250th hotel in Riyadh. We just did a twin Taj and Vivanta in Dhaka. So on an asset light model or operating lease model, we will make certain moves to strengthen the brand internationally also.
Well, wish you more power for that. Just wondering your first comment in this answer that you gave me. By the way, it was heartening to see Ginger doing the way it has. But the first comment in the answer that you gave me, Puneet, just before we wrap up this interview, was that the cash flow gives you the ammo to be able to do large consolidation. Did I hear you correct? Are you on the lookout for
any
something like that?
any any consolidation opportunities, M&A opportunities that may come in without taking on debt, we are very well positioned through our platform with GIC as well as our own internal cash flow generation.
Actively looking? Anything on the anvil?
We are always looking. Besides fund managers, if you get to know of anything else from somewhere, please let us know.
Sounds good. Okay, Puneet, congratulations on a great year, almost a banner year of sorts, and hopefully you can do much, much better than that in FY24. Thanks for speaking to us today.
Thank you for having me. Thank you
The
so
pleasure was
much.
ours. Viewers, thanks for tuning in.